Hello there. Welcome to the Open. Stocks closing at record highs yesterday. We're going to be all over that, but let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Shares in Lululemon surging in the pre-market. That's after the Canadian apparel company posted profit and revenue in its latest quarter that topped estimates, driven by higher same-store sales and growth in international markets. Lulu also boosted its full-year revenue forecast, and it announced that the CEO, Calvin McDonald, is stepping down at the end of January. Some analysts see the move as positive, noting that the company has been facing slowing sales. Costco is out with its latest results, and the wholesale giant logged higher profit. It saw total revenue jump more than 8%, beating estimates. Same-store sales across Canada, the US, and international markets topping expectations. Costco says results were helped by a record-breaking Black Friday for its US e-commerce unit. Shares in cannabis stocks spiking in pre-market trading. Look at that. Tilray up almost 40%. That's after a report in the Washington Post that U.S. President Donald Trump is expected to push the government to drastically loosen federal restrictions on marijuana. According to the report, Trump plans to direct agencies to reclassify the drug under so-called Schedule 3, reducing it to the same level as some common prescription painkillers and other medications. Trump's administration has been seeking to reclassify cannabis as a less dangerous drug. And shares in Broadcom under pressure in the pre-market. The chip company beat on revenue and profit, but investors seem to be focusing on its AI backlog and margins. Broadcom's backlog of AI product orders was weaker than some analysts had expected, and the company held off on giving an AI revenue forecast. It did warn that total margins were being affected by AI product sales. And it looks like we're going to get a slightly weak open for the broad U.S. indices this morning, but the S&P did hit a record high at the close yesterday. The TSX Composite also closed at a new high. Let's see how it traded yesterday. And, up 24%, excluding dividends in the past 12 months. Let's check out gold. It's had a rally over the past few sessions on hopes that the U.S., not far off record highs again, on hopes that the U.S. Federal Reserve is open to yet more interest rate cuts. And let's have a look at the Canadian dollar. Usually when the U.S. cuts interest rates, tends to push down the greenback. And of course, that tends to strengthen our currency, which has bounced lately. And finally, let's have a look at Bitcoin. Bitcoin way down from its records and under a little bit of pressure today. Broadcom stock, as you see, down about 5% in the pre-market. The company posting solid results in the latest quarter, but there is angst among investors over profit margins and whether the AI backlog is growing fast enough. Let's get more from Pierre Ouimet, Head Investment Strategist at UBS Canada. Pierre, thanks very much. I know it's just one day, but there is concern that these AI plays such as Broadcom can maintain the pace of hectic growth.
Yeah, I'm a bit surprised by the market reaction. I mean, typically, I think, sometimes you sell first and ask questions afterwards. But it was a beat. It was a clean beat. There is worries about margins. I guess their sales guidance was a little bit disappointing, though. So I think that's what's driving the stock down this morning. But I think it could be a little bit of an overreaction, a little bit like we saw in Oracle. We don't think the AI story is over by a wide margin. It's likely to continue. And so from that perspective, I think this is probably an opportunity.
I mean, I know that you wouldn't be buying AI stocks indiscriminately, but what about the NASDAQ 100? If you were to be making an index bet, and I don't know if you ever do that at your shop, I know, or, well, you can clarify. Would you be putting money into the NASDAQ 100 as a whole?
Well, we like technology, so therefore, yeah, that's clearly an index we'd be looking at. We do from time to time use some indices in our portfolios, but yeah, we think AI's got still a long ways to go in terms of its penetration, in terms of its economic impact, and it's not over yet. I mean, the markets go through the kind of these reactions from time to time, where there's a little bit of consolidation, and any small slip up is a reason to take some profits, because there are some significant profits in the area. So that's another thing. It's an area that's overowned. So from that perspective, there's always a risk that if something disappoints, even at the margin, then yeah, you're likely to see some weakness in these stocks.
But you don't see danger signs that we could be headed for a crash in these AI stocks?
No, definitely not a crash, but we could be in for some kind of consolidation. And I think that's what we're going through right now. But it's, I think as we move forward, I think you'll see more opportunities in that area, and growing opportunities as well. And on top of the fact that the technology is evolving so rapidly as well, that these applications will have a significant impact not only in the economy but socially as well. So it's I think the long-term outlook for AI is still very bright.
Yeah, I mean, it is interesting. It's like we're talking about steam engines early in the 1800s and kind of basing our predictions on what's going to happen when these things were tiny and fueled by coal. AI just getting going. Costco, it has been an investor darling. Anything jump out for you in the latest results?
Well, yeah, it's comforting to see these results, because there's a lot of worry about the U.S. consumer, and this kind of continues to indicate that the consumer is far from dead in the U.S. And it was interesting also to see that the online sales were really what drove the quarter as well. So that's I think that's a good sign for some of our Canadian companies like Shopify, for example. So very robust numbers, and I think it's encouraging as far as the economy is concerned, the U.S. economy.
Oh, it's interesting. Costco has been sagging over the past year. I wasn't aware of that. Can you suggest why investors have grown colder on the stock?
Well, I think it's a general malaise vis-a-vis the consumer, and I think that's a little bit overdone as well. Yeah, there are parts of the consumers, the whole overall consumer picture, that some consumers, a large portion of the consumer segment is not in a particularly good financial position, but most of the high income earners, the top quartiles of income earners continue to spend money, and it seems to be kind of the reality going forward here, that those continue to sustain the economy going forward. Cuts in interest rates would help, but we'll see what happens in terms of further cuts going down the road here.
Give us your take on Oracle. That is certainly is something of a fallen angel right now. Would you put money into Oracle right now, Pierre?
Well, a little bit hesitant in that particular case, but no, yeah, we'd be kind of waiting for waiting for some confirmation in future quarters of what the direction of the company, in which direction they're going. So I'd be a little bit hesitant there.
We're hearing more than $100 billion US in debt, for example.
Yeah, well, the leverage is a concern, and I think they're trying to do everything in order to right the ship from that perspective. So it's that's a concern.
Anything jump out for you with the latest bank earnings results, Pierre? Because of course the bank stocks have been hitting record after record lately.
Yeah, well, the last quarter was very robust. I mean, you looked at just, the top line was up 7% across the board. And you look at profits before taxes and provisions, they were up, I thought somewhere low 20% or something like that. So, yeah, the net interest margins improved slightly. The provisioning wasn't necessarily a concern. And it looks like the coast is clear as far as the Canadian banks are concerned. So we'll see as we go forward here. But the thing is, these banks are relatively highly valued right now. So it's actually, look at some of the dividends are even below Royal Bank, for example, below 3%. So it's that's the same yield as the market overall. So it's there's a valuation concern there. And maybe I think we could probably see this area consolidate over the next few months as we go forward.
That's interesting. Yeah, I didn't know the yield on Bank of Canada or Royal Bank of Canada had gone so low, only 2.8%.
Well, it's what happens when stocks go up.
Yeah. But traditionally, you would hope for a richer yield than the market if you buy one of these things.
One would expect that. It's actually, that's not where the yield in the market is right now. It's mostly in infrastructure stocks, some energy stocks. I mean, think of a company like Canadian Natural Resources, for example, a 5% dividend yield, which is it's on third. I mean, it's kind of crazy when you compare it to a Royal Bank or some of the other banks.
Thank you very much indeed, Pierre. Great hearing from you.
Okay, my pleasure. Thanks.
Pierre Ouimet is head investment strategist at UBS Canada. Coming up, it's the last call for Canadians to get their share of that $500 million class action settlement in the bread price fixing scheme. We'll have more on that next. Okay, so it's the last call for Canadians to get their share of that $500 million settlement in a class action lawsuit that accused George Weston, parent of Loblaw, of being part of an industry-wide scheme to fix the price of bread. Let's get more from CTV's Scott Hurst. Scott, this is the deadline to submit one's claim. What should you know about doing the paperwork?
Good morning, Andrew. This is your chance to be part of the $500 million settlement. As you mentioned, today is it. It is your last call to submit a claim for a share of the $500 million bread price fixing settlement related to the alleged industry-wide price fixing of packaged bread. So let's walk through the details of what you need to know, what viewers need to know to be able to take part. Anybody in Canada, adults in Canada, can apply. Canadian residents, no proof of purchase is necessary. So no stress trying to find an old grocery receipt. You're eligible if you bought packaged bread for personal use between 2001 and 2021. You just need to file an online claim. There's a separate claim process for Quebec residents. Now, as you pointed out, this stems from the class action lawsuit that accuses Loblaw and its parent company of engaging in an industry-wide scheme to fix the price of bread. The suit alleged that the companies and other big players in the industry engaged in these practices from 2001 for several years, ultimately, Andrew, impacting the price that we paid.
And then what comes next? Is there any timeline on how much money we'll get?
At this point, you can expect to receive compensation within 6 to 12 months, so the money should be in your account at some point in 2026. Payment, according to the website where you file the claim, will be made by Interac e-transfer or, if requested, by check, and the amount of compensation will ultimately depend on the number of claims. And so the other question, what comes next from a legal perspective? The law firm at the center of the class action says it is still pushing for more accountability. I believe we have a clip from that law firm to play.
We've been litigating for 8 years. It's been very difficult. It's an expensive, protracted, slow process. But we did our best to hold Loblaw's feet to the fire. But to their credit, they came to the table. But the most important thing, in addition to the money, the other really important feature is that we're going to be getting information from Loblaws in Q1 next year, which we hope will, let's just say, bolster our cases against the other alleged co-conspirators.
Other major Canadian grocers, including Metro, Sobeys, Walmart, Canada Bread, and Giant Tiger, were also accused of price fixing during the time frame of the suit, Andrew. They have all denied involvement. But bottom line, for residents, people like you and me who bought bread over the last 20 years, the deadline is today to be part of this class action lawsuit settlement.
Yeah, I wonder, could we just Galen Weston could just invite us all to his house and we could all just sit down, have a few snacks, just go through the cupboards. He can afford it. Anyway, thanks very much, Scott. Scott Hurst of CTV News. Coming up after the break, Costco, its stock has sagged over the past year. It topped sales and revenue estimates in the latest quarter. We'll get more after the break. Costco beat sales and revenue expectations in its latest quarter. Digital sales, e-commerce, they were up more than 20%. Let's get more from Oliver Chen, Managing Director and Senior Equity Research Analyst at TD Cowen. Oliver, thanks very much for joining us. What was important, do you think, in this latest quarterly report from Costco?
We continue to be really excited about what Costco is doing, in part because they're executing the exceptional value, and that's what customers are looking for. The comp store sales were 6.4%. Also, they had solid renewal rates above 92%. So customers are happy and they're coming to Costco, and it's been a very consistent retailer. It's the club model. So the business model is highly focused on offering members the best value possible, and they're very much outperforming the retail sector. As we zoom out in retail, Andrew, traffic is down about 2 to 3%, and retailers are struggling to make comp store sales of positive 2 to 4. Costco's been consistently above 5% comp store sales, in part because this business model is so diversified, so robust, and you have needs in grocery plus diamonds. You have chicken plus diamonds. So you're getting discretionary and you're getting a fabulous grocery business. Everybody likes the Kirkland brand as well. Consumers like private label, and Costco's private label is very trusted. So overall, very impressive. As we look forward, technology is a big deal. More personalization, leveraging the loyalty program, the marketplace model, digital advertising. Those are all things on the horizon, but this company will always be committed to customers and employees first. And it's a real champion of value, and that matters too.
Nevertheless, though, the stock down in the past year. Why is that?
Well, the stock is expensive. We think it's expensive, but worth it. It's trading at above 40 times PE. You contrast that to other retailers on the sector average, which is closer to 15 to 20 times. So it's an expensive stock. So expectations have been very high, and there's been some rotation into riskier ideas. We like Costco alongside Walmart as well. And another stock we like is Ulta too. But expensive, but worth it. And investors have been looking for bargains. This is a retailer that's executed well for many years. That's in part why we like it, because the winners keeping on winning and scale matters. And also being a wholesale model is quite unique, because what drives this model is renewal rates and a more constant income stream in terms of the membership fee that you pay.
I'm just looking, I'm not sure we can put up a comparative chart of Walmart, WMT, and Costco, COST, because it's really fascinating. A 5-year comparative chart shows that Costco has been a superstar. It's beaten the S&P 500, no doubt, but it's been weak lately, and Walmart has actually caught up with it over 5 years.
Yeah, well, the Walmart story has been evolved in terms of Walmart having the everyday low price core grocery business, which is about 60% of revenues being food, and then also bolting on a lot of great technology and being a real competitive force relative to Amazon. Walmart also has a jewel of the business called Sam's Club, which is the wholesale competitor to Costco. But Costco's been a leader in terms of private label development, very, very happy customers, and traffic that's almost too high, and productivity levels that are extremely high, just given how much customers like Costco. Costco's also had many, many years of consistency with comp store sales growth. We've seen a little more volatility with Walmart in the past, and also an evolving Walmart. That being said, we publish Walmart as our best idea, and it's been a stock we've recommended for a few years, in part because of AI, in part because of the marketplace, but also grocery is very hard and low margin.
It's interesting. You do note that the renewal rates for the subscriptions at Costco down. But that's partly, they say, or I'm not sure if this is you or the company, because a lot of the signups have been digital and they may be less sticky.
Yeah, that's true. A true statement. So you're balancing that. The in-store signups are stickier. Some of the programs they have where they're having members sign up online, those have been less sticky in terms of the renewal rate mixes. Overall, though, I would still advertise your membership online as well and accept that trade-off. Because those are great customers to have and younger customers, but it's part of the math of that mix. So we'll see some pressure and softness there. It's something to watch, but having a 92% plus renewal rate is a great absolute level.
That's interesting. I mean, our market, about 13% of their stores are in Canada. So obviously they find Canada a relatively friendly country.
Yeah, Costco's been a great international story. China, Asia, Europe, Iceland, France, 921 units. But a lot of what Costco does is globally appealing in terms of the fixed margin on the prices. You know you're getting the best bargain there. Furthermore, Costco is very curated. As you think about the future of retail, it's simplified and amplified, but they only have about 4,000 SKUs. So when Andrew's looking for a computer or a vacuum, it's a trusted source, meaning you're not seeing 20 ideas, you're seeing the best of a few. Having a lean choice count has been important with the real volatility of supply chains that we've seen and tariffs. And Costco's been able to manage that pretty tightly. The other thing about Costco is they pay their employees well. Retail's a tough place. It's not like media or your job or my job. Retail is not an easy business, and treating their employees well means employees treat customers well. That matters too, as this company has low turnover, and it matters for the member experience. The other thing, maybe this isn't even a retailer because most of their profits are from the membership fees. So thinking about that too from another lens is part of why the valuation is high, because of the stickiness of the membership fee in some comparison to like technology and software companies versus a traditional retailer, which is trying to manage merchandise margins with a little more variability, high-low pricing strategies.
That's interesting. Yeah, you go into a place to buy, say, a vacuum cleaner, and you're just deluged. And some people tend to just not buy anything. Yeah, I prefer that. Just give me one or two choices, and I'm out of there. Yeah. Thank you very much indeed. Really appreciate it.
Happy holidays. Go shopping at Costco. Buy the best chicken, buy the jewelry. I buy the clothes too. It's a one-stop shop and it's curated. Happy holidays.
Thanks. Yeah, it's just the crowds, the lineups on that parking lot. That's what deters me. Oliver, thanks very much. Oliver Chen, Managing Director and Senior Equity Research Analyst at TD Cowen. The opening bells are up next. Opening bells at the NASDAQ. Wealthfront is ringing the opening bell. At the NYSE, it's Chipotle celebrating 4,000 restaurants. And at the TSX, it's Original Mining celebrating the company's listing on the Venture Exchange. It's time for the first 15. Trading is just getting underway on this Friday morning. Happy Friday, by the way. The TSX pushing further into record territory. You can see U.S. stocks down. The S&P 500 and the TSX Composite both closed at record highs yesterday. Let's check out a couple of stocks of interest. We are focused right now on Lundin Mining. It and partner BHP have filed to join an Argentinian incentive scheme for big investments, and it's centered on their Vicuña project. It's a huge copper, silver, and gold project. Could be, allegedly, the largest foreign direct investment in mining in Argentinian history. And so they're pursuing that one. Investors seem to like the word on that. And Tilray, we saw a bunch of the cannabis stocks moving up in the pre-market after U.S. President Donald Trump indicated that he's interested in classifying cannabis as a much less dangerous drug. But of course, we've seen false starts, hopes for U.S. deregulation or decriminalization in the past, only to see them dashed. Let's check out some stocks south of the border. We are joined by the one and only Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much indeed for joining us. Start off with Broadcom. Investors impatient here, it seems, Jeff.
It's a little bit impatient. The quarter that they've come out with is seemingly nothing bad. We had 3 investment banks raise their price targets on the stock so far this morning. Those include Morgan Stanley, TD, and JP Morgan. But there's a backlog here, a backlog of work related to the AI sector. It currently stands at $73 billion, which in many other industries would be a wonderful backlog that a lot of companies would love to have. In this case, it's a little bit short of what analysts had expected and what investors wanted to see. The other thing that's weighing on the stock this morning, and this is one of the worst performing stocks in the S&P 500, is that the margins on the stock, there's some pressure seen there. As the company is embarking on some new custom AI chips, what is seen here is that the company's margins might be under a little bit of pressure going forward. So yeah, you have, an 8% drop now. That is worse than it was in the pre-market session. So definitely this is one to watch. This is one of those great big chip companies. They wanted to eventually rival NVIDIA. And the backlog here is what's in focus today. There is some potential that maybe some of the backlog is not being accounted for. Maybe some of that's a little bit further out, but they called it a minimum, $73 billion minimum. Apparently that's a bit of a disappointment.
And Fermi, they are working on a private electricity grid in Texas to power AI, but apparently a tenant has bailed.
A tenant has bailed and the stock is getting hit really hard as a result. It was down 43% in the pre-market session. The tenant was worth about $150 million to the company. And Evercore ISI came out this morning and said this is a clear negative. Down 42% in the regular trading session. This is a pretty big hit to this company. Of course, we've seen a lot of exuberance and a lot of share price appreciation in this kind of AI-related sector, and the data center build-out was supposed to require a huge amount of power. So this is another case where you have a lot of high expectations, and certainly seeing a tenant pull out of an agreement here is a negative for this company this morning.
And the company headed up by Rick Perry, the former U.S. Energy Secretary and former governor of Texas. And then finally, Lulu. It's got to be a bit annoying if you're the CEO and you're stepping down and the stock jumps.
I would think that maybe he needs a drink at the end of the week after you see the stock jump. This is the top performing stock in the S&P 500. The company announced that he's on his way out the door, but it wasn't the only reason why the stock is jumping. It's worth noting that the company also announced $1 billion in a share buyback plan, and it announced kind of increased guidance for the full year, including some expectations that holiday sales are so far coming in a little bit stronger than expected. So maybe the CEO shouldn't take it entirely personally. However, there have been a few analysts on Wall Street, including at Bloomberg Intelligence, that came out this morning that said CEO change might be something that the company needs to pursue a little bit more of a turnaround plan. So the stock is up sharply, and maybe the CEO is hopefully not taking it too personally.
Thanks very much, Jeff. Jeff Morgan, after this, we are going to be drilling into the earnings we've been seeing over the past few weeks. Stick with us. Despite fears of a global trade war that drove shares down in April, corporate profits have held up pretty well. Let's get more on corporate earnings and the markets. We're joined by Ryan Beloge, founding principal at Claro Advisors. Ryan, great to see you. Tell us what trends, start off with the States if you would, what trends have emerged, do you think, in earnings from Q3?
Well, most notably, they continue to be very strong. I mean, you've got these big corporations, specifically tech, churning out huge profits and plowing them back into reinvest into the AI trade, the race that we're calling it, into building out this AI world. And so because of the strong profits, they've just been able to continue to double down, triple down on these bets that, because they are bets. We don't know what they're going to produce in the future. We have some ideas, but they are speculatory to some degree. So they've been strong, and it has allowed them to continue to make these bets into the AI space.
Is there anything that's coming our way in the markets in the way of an iceberg? I know a black swan, by definition, you can't predict, but are there any risks that you think investors are avoiding generally? Or, sorry, ignoring unduly?
I think generally there might be one in particular to me would be OpenAI. I mean, it feels like that is by far the market leader in the AI space, and a lot of promises and future spending promises have been made as it relates to them, and yet their revenues are still only $20 billion, and so they're making huge hundreds of millions of dollars in future outlay commitments with little revenue now. And I think that is why maybe 2 weeks ago there was like a code red at OpenAI where they were a little bit concerned about the new Gemini product from Google. And so I feel like you've got to watch that one in particular, because there is some circularity around that name and the ripple effect to other names. Oracle would be one that are really counting on OpenAI to deliver. So if I'm trying to predict, it's very difficult to do that. But if there is one kind of you pull a string and the whole thing falls apart, it could be OpenAI.
OpenAI, because they've racked up so much debt on tiny revenue.
Yeah, exactly. Yeah, I think that's my feeling there. It's just that you were starting to see a lot of these companies use cash for their investments, and now you're starting to see some debt being layered on. And so that, as a shareholder, I think that's the one tiny concern. And now I'm talking about big tech in general, where you feel like, okay, plenty of money to spend here, but if we're going to be leveraging future earnings, that might have to be reflected in valuations. And you can see that the net cash on these companies have come down quite a bit. I mean, these used to be really cash-rich companies, and they're much less so now. And so I think the quality is deteriorating to some degree, and I think that's really going to force some return on the investment here in the more near term than just projecting it's coming down the road in years. I think we're going to have to start seeing some return sooner than that.
What about the interest rate cuts? You reckon the history shows that interest rate cuts in a non-recessionary environment have been a good omen for the market?
We think so. I mean, I think there's been 3 soft landings since World War II, according to our research. And this would kind of be the 4th. I mean, I think they've kind of landed the plane. We're not totally to our target. And that's the one, other concern we have is we really don't want to be going back to the 1970s where inflation's kind of 2 and then it's 4 and then we've got to now increase rates again. So if we can avoid that, we would like to. Obviously, that's not good for the market. So I think generally that's how we're feeling. We would like rates to be, this is a good spot for them probably, but the key is the longer term, the 10-year. I mean, as we know, that does not move with these federal funds decisions. So the market dictates what it thinks the longer term yields should be. And that they've been pretty defiant and stubborn around the 4%. They haven't really budged. And I think if you could get those to soften, you'd see a ripple effect in certain big sectors of the economy, notably real estate, of course, where that would just apply a little bit of alleviated pressure to that sector. But you're starting to see dissent, more dissent amongst the Fed. That's pretty rare. I don't think there's been 3 dissenters since 1994. So people are starting to say, look, I don't totally agree with this strategy, and some think we should be cutting even more. So it's definitely something we're keeping our eye on.
Give us a final thought. If you had to choose between Canadian and US stocks, and I know it's an artificial dichotomy, but if you had to choose, which do you think offer the best returns over the next year?
We would probably stay domestic. We do think the innovation in the United States is superior. Really, that's to any other country. And so I think if you're looking towards where's my best future dollar invested, we'd probably stay domestically. And that's not to say there aren't great companies in Canada. We noticed TD Bank stock has jumped up nicely over the last few months. So that's doing very well. But if you had to, make me pick, that's what I'd choose.
Ryan, thank you very much indeed.
Thank you.
Ryan Belanger, founding principal at Claro Advisors. And yesterday on Market Call, we were joined by Bruce Campbell, president and portfolio manager at Stone Castle Investment Management. He was covering Canadian stocks, and his top ideas were Energia, Tantalus Systems, and Happy Belly Food. I love that name. Today, we are going to be joined by Ryan Bushell, president and portfolio manager at New Haven Asset Management. The topic, Canadian dividend stocks. Up next, Lululemon rallying after a rough year. The chief executive officer is stepping down. We'll have more after the break. Lululemon stock rallying today after the CEO announced his plan to step down in January. Let's get more from BNN Bloomberg's Lindsay Biscaya.
Hi, Andy.
Hey.
Yes, this is big news today. The CEO, Calvin McDonald, stepping down, as you mentioned, at the end of January. He will continue as a senior advisor until the end of March, also stepping down from the board of directors. So we're seeing Lululemon over the past year struggling quite a bit. But today, as you mentioned, the stock bumping up after this news. The stock has dropped, though, more than 50% in the last year. Many economists saying this news today opens the door for a kind of strategic reset of sorts from the top down. And after the company's been seeing slumping U.S. sales in particular over the last year, as well as just more competitors in general, when you think about the landscape of other brands that offer yoga wear, Alo Yoga, Nike and Skims partnership as well. And also just less people wearing yoga pants as much as we were a couple of years ago, right? Like the trends are shifting more towards jeans and different types of wear, more work wear instead of just lounge wear, which was what Lululemon really was king in. And so with all of this combined, Lululemon has been struggling, as I mentioned, but this is a time for potentially a strategic reset. We know the CFO and the chief commercial officer will serve as interim CEOs until a new CEO is found.
The company did increase its forecast, though, improve its forecast.
Yeah, it did. I mean, this comes after the company cut its fiscal year guidance twice and lowered its sales guidance once. But now, as you mentioned, the company is saying things are looking up. They now expect net revenue to be between $10 to $11 billion. That's a growth rate of 4 to 6%. And Lulu says the improved guidance is driven by international sales. We've also seen sales in Canadian stores ticking up ever so slightly every quarter. And the company also says it expects higher tariff rates to dent profit by about $210 million. That's compared to what they expected initially, which was $240 million. So not expecting to be hit as hard from those tariffs as they originally thought in the next year. And so, now we're waiting today. We're getting feedback to all of this news, of course. The former CEO and founder of Lululemon, Chip Wilson, he's been very vocal in the past, a controversial figure at times, but he is still the largest active shareholder of the company. And he's saying that the board only acted after increasing pressure from him So he's speaking out today, and he says the CEO search should be led by new independent directors with relevant expertise.
Right. The Wall Street Journal, I think, reported that he was behind the scenes planning board changes, pushing for board changes.
Yes. And he's taken out a whole page in the Wall Street before as well. So he has been planning things in the background, and we have reached out to him today to see if he'll join us in chat. So
excellent.
We'll have to wait and see.
Lindsay, thanks very much indeed. Lindsay Biscaya. Okay, coming up, we'll check out some early market movers on the TSX. AI stocks were roughed up on Thursday after an update from Oracle that didn't go down well. But heading into the new year, there are plenty of bullish views on the biggest AI names. We're joined by BNN Bloomberg contributor John Ehrlichman. He has a new story about that on our website. And John is the host of the investing channel Ticker Take on YouTube. John, remind us of the investor thinking here.
Well, I think at this point in the year, after the run-up that we've seen in a lot of these AI-related stocks, Andy, everybody is very curious about positioning for 2026. And, there have been a couple of things that have stood out on the negative side over the last few days. One, you just talked about it. Every time we've got a company updating how their business is benefiting or perhaps not benefiting as much as people might have thought from the AI boom, as is the case with Oracle, spending huge amounts of money to build up there, and people just weren't impressed with how much was coming in the door. And let's not forget that you had, people like Ed Yardeni in recent days, longtime strategists, who said, you know what, tech is already a big part of people's portfolios. Give it a breather. You don't have to be overweight tech anymore. It's already literally 35% of the S&P 500. So he was shifting away from the Mag 7. But in a lot of the conversations I'm having with bulls, they look at things like workforce. Jed Ellerbrook is a great example. He's with Argent Capital, and we spoke to him on Ticker Take this week. He said, look at how much companies spend on labor in the United States, and he estimates it's around 15 trillion. There's different estimates, anywhere between 10 and 15 trillion dollars a year spent there. He says it's about 15 times what companies are spending on semiconductors. Now, semiconductors, Andy, we know, if you look at in the rearview mirror, it's an up and down kind of journey for investors. The question is, if AI productivity can be enhanced in big ways by continuing to buy these chips and develop these chips and develop the AI ecosystem, should we worry about the Oracle story, or should we worry about just being left behind if we're not looking at the economics of where this is going? That's basically his math and why he's still bullish on a lot of these companies.
It is interesting, though, Ed Yardeni, all right. He calculates that if you combine communications technology and or communication services and infotech, you're looking at about 45% of the market cap of the S&P 500. Yeah.
It's in your portfolio. Like, you don't have to worry about whether you've got tech. You've got it whether you like it or not, which is why he's making the argument that maybe in the new year, if you're an investor, you look at other companies in the S&P 500 that are still going to leverage AI. They just don't have the name NVIDIA or Alphabet. But Jed Ellerbrook feels differently. I mean, he's still bullish on a lot of these chip companies like NVIDIA, like Broadcom, like a chip equipment company like Applied Materials. And it is interesting, just as you take the Mag 7 as an example. I know Alphabet's had a great run. I was looking at what the analysts think about these companies. On average, just to be clear here, I know some people like analysts, some people hate the analysts, but on average, the analysts still are very bullish on stories like Microsoft and Meta and Amazon, all three of which Jed Ellerbrook told us in our Ticker Take conversation that he likes in the new year. And by the way, he's fine if you're looking for companies that are going to leverage AI, but he still thinks you need to find the best suited companies for doing that. So he likes companies like ServiceNow, which is already a really strong software player that can leverage AI. He also likes Tyler Technologies, which is not unlike Constellation Software in being able to leverage AI. So it is some good food for thought, given we're having a little bit of turbulence here in the AI story as we head into the final weeks of December.
Right. I'm just looking at ServiceNow. Like a lot of software stocks, it is down on concerns that AI will be so disruptive. John, apparently one study found that, sure, AI can help programmers work much faster, but they have to spend a lot of time then checking for the errors.
Yeah, and so do we, right? I mean, anytime literally you turn to ChatGPT or any a generative AI tool today, you feel great for a second until you're like, am I sure I can go with this? And I think that's going to be a reality for a lot of people in the short term. But I would be looking at what companies do. You know, at the end of the day, I would be looking at the signals that are coming from corporate America. Like if this view from Jen Ellerbrook is correct, that it's not like the labor force is going to go down. It's just that spending on the AI tools and the semiconductors behind those tools has to ramp up to be more sort of on par with the normal way we think of productivity, is just people being more productive. I'd be looking to see what the companies themselves are saying, right? So I know we're looking at what Oracle is saying today, but what are the companies saying about how many of these AI tools they're going to use? Because you're right, there's plenty of mistakes out there. We've heard countless stories about that. But if the spending is going to continue there, I think that is the big question for investors, who sometimes end up kicking themselves when these tech stories continue to climb and they felt like, you know, the easy path was to shift away from it. Especially since tech has that big weighting, which you just talked about. Like, that could continue to be sort of the story of outperformance. I don't know about you, but I mean, this has felt like one of those very unique chapters where it's hard to gauge the right path forward, since traditional valuation metrics haven't been that helpful so far. And we'll see what happens if the Michael Berrys of the world end up being right, or if Jensen Huang has the flag to wave for years to come here.
John, thank you very much indeed.
Thanks, Andy.
John Ehrlichman, BNN Bloomberg contributor. And you can see John's latest piece on this topic on our website, bnnbloomberg.ca. We've got lots ahead. We saw Premium Brands, the big preparer of specialty foods, in a massive U.S. acquisition. We're going to have more on what this deal means for investors. Welcome to the second hour of The Open. Let's check out the stories we're bringing you from the BNN Bloomberg newsroom. Another look at shares in Lululemon. They are moving up 12%, but look at that, still down almost 50% in the past 12 months. That Canadian apparel company posting profit and revenue in its latest quarter that beat estimates. It was driven by higher same-store sales growth, including growth in international markets. Lulu also increasing its full-year revenue forecast and announcing that the CEO, Calvin McDonald, is stepping down at the end of January. Some analysts see that move as positive, noting that the company has been facing torpid sales. And look at that, a serious move up in some of the cannabis stocks after a report from the Washington Post that U.S. President Donald Trump is expected to push the government to drastically loosen federal restrictions on cannabis. The report says Trump plans to direct agencies to classify it as a Schedule III drug, and that would reduce it to the same level as some common prescription painkillers. Costco is out with its latest results, and the wholesale giant logged higher profit. It also saw total revenue jump more than 8%, beating estimates. And same-store sales across Canada, the US, and international markets came in higher than expected. Costco says results were helped by a record-breaking Black Friday for its US e-commerce unit. And there's the TSX setting a new high today, topping the 31,700 mark. Let's check out US markets. They wobbled in early trading. We did see some selling in tech stocks amid concerns that Broadcom's AI business isn't growing as fast as hoped. Let's have a look at oil. What a miserable year for crude, and oil can't get any traction, still stuck below $58 US. Let's have a look at gold, because gold is practically at a record. The latest price I have for spot gold is, so there is the February future. Spot gold now trading at 4,345. So it's practically back at the record for spot gold. October 20th at 4,356. So we're only about $10 down from the record for spot gold. And gold market investors or gold stock investors are responding. TSX index, that's an ETF that tracks the TSX gold stocks, and it is hitting a record high today. Let's have a look at the loonie, because it has shown signs of strength on prospects of yet more interest rate cuts from the U.S. Federal Reserve. Premium Brand Holdings, the preparer of specialty foods, shrink-wrap sandwiches, etc., is buying a U.S. outfit called Stampede Culinary Partners for more than $660 million US in cash and stock. Let's get more on what the deal means for investors in Premium Brands. We're joined by Rebecca Telcher, Portfolio Manager at New Haven Asset Management. Rebecca, great to see you. Happy Friday. And thanks for joining us. Happy Friday. Are you a shareholder in Premium Brands? Have you been following it for a while?
We are shareholders, and we actually just added more to the name a few weeks ago, and it was my top pick on BNN Market Call last week. I mean, they are doing all the right things, with regards to investing in the business. So, for the past few years, they've been quietly expanding their capacity to have more production in the United States. So if you think about it, they're pretty well established in Canada. Let's just say their largest customer, for example, a Costco, is saying, okay, great, we love your products in Canada. Can you bring them to the United States? We think they would do well. And Premium Brands, when it comes to capacity, going nationwide in the US is a different ballgame than in Canada with regards to the number of stores Costco has. So they've been quietly building capacity. They've spent about $750 million on new capacity in the United States. And now that's pretty much done. So I think for the past few years, the stock really hasn't been going anywhere. Stock was pretty flat, because again, we're used to this, we invest heavily in pipelines. You put the capital up front and then you benefit from revenues that come later on. And that's exactly what Premium Brands has been doing. So now the capacity is pretty much complete. They're ready, and they just launched their first, nationwide meat stick, like their largest new product launch in history. It's a organic sugar-free meat stick. It's launched in the United States, will be coming to Canada soon. So they've been doing everything they said they've been doing, which is going really well. And then all of a sudden now, two days ago, they announced this acquisition. Again, it really fits their strategy. They have excess capacity in the United States. I'm talking about this Stampede business. So they're buying it for their capacity in the United States. They are nationwide. They have good relationships with, the Costco's, the Sam's Clubs, and they also offer a new, cooking facility, sous vide, which is new for Premium Brands. So, we think it's a good deal, and it's on the conservative side. They took advantage of a really strong stock price. They issued equity, and that's so they're not going to be taking on more debt. They're actually going to be reducing their debt because they're going to be using some of that equity to pay down some debt as well. So the stock is off right now because they issued equity at a pretty large discount, but we think they're at an inflection point with regards to their growth.
Right. So the stock actually up a little bit this morning, but did it fall yesterday, Rebecca, because of the word of the stock issue?
Yeah, so
Okay.
I mean the discount, the stock was trading at about 102 prior to the announcement of the equity issue. The equity
Oh,
issue
okay.
price was 97.50, so pretty steep discount. And then it traded below that, which I'm not quite understanding why. But regardless, I mean, we are still very confident in the stock price over the longer term. It's very rare to find such a disciplined management team that's doing all the right things for such a long time. And they haven't really been getting credit for it in the market, but I think now we're starting to see that change. Like RBC upgraded them 2 quarters ago. And so we're starting to see them actually get credit with regards to everything they've been doing with regards to their capacity expansion and their disciplined approach. For example, when there hasn't been much for them to acquire over the past few years, they've been paying back a lot to that shareholders, been doing 10% a year dividend increases, which obviously as dividend investors we like to see. This year, now that they've been doing so much growth, they're not raising the dividend. They won't cut it, and they don't need to, but they have better places to deploy that capital into growth, acquiring these companies at very good multiples.
Yeah, maybe we could pop up a 10-year chart for premium brands because they fell early in the pandemic. I guess people were worried about retail sales or sales through gas stations and stuff. And then the stock went up through into 2021, then fell, but it sure has been rallying lately.
Yeah, so they do. So a lot of it is, they sell to Costco and grocery stores. They do have a percentage of their business that is, food service, so to restaurants, as well as convenience stores. They don't really have that much exposure to like the discounters. Like, their products are more, and they're called premium brands because they offer, premium products. So their customers really, you could find their products, for example, at Farm Boy locations, Trader Joe's, and also a lot through Starbucks and those clubhouses. So yes, it came off with the pandemic, just like almost every retail stock.
Yeah.
And then they came off earlier this year with regards to tariffs. But again, they had very little cross-border sales. They have their distributions in Canada. They have distribution now in the US. Very little cross-border trades. If anything, they were talking, and they, not that they want to advertise tariffs being good, because tariffs are not good, but they would actually benefit from a tariff situation because there was an opportunity to acquire businesses at a very low multiple, which would be good for their business. And they've been able, they said that the M&A environment right now is better than they've ever seen in their history. So again, lots of organic growth, lots of M&A growth. The capacity is built. So it's just a question of when they take on those sales. And we're seeing that firsthand with that first product launch that they did last month, and we're seeing that so far there's really good traction in that product.
The meat stick with no sugar in it that you referred to.
No sugar, organic, yeah. So none of, you would think, right, like meat stick, sugar, but you would be surprised there's pretty much sugar in everything.
Yeah. They have giant sandwich factories in Columbus, Ohio and Reno. And apparently they have up to 10% of the US market for packaged sandwiches. They dominate in America.
So again, one of the reasons the stock was off, I believe a year or two ago, was they do all the breakfast sandwiches for Starbucks in Canada. And so when Starbucks was closing stores and having, trouble, they got hit with that as well. But, we just met with management a few weeks ago, and they pretty much do all the prepared foods in almost every coffee shop in Canada. So if a Starbucks is closing and a new, coffee shop is opening, like what management explained to me was that maybe Starbucks stores are closing, but the actual number of coffee shops in general is still growing, as it's a growing industry, and they pretty much do all of that in Canada. There's an opportunity for them to enter the United States. They do, for example, the pastrami, I believe it's pastrami sandwiches in all the Costco's in the United States. So, you wouldn't think about it because premium brands, you think about it and you're like, I don't really know exactly what they do. I don't really know that brand, but that's a really good thing. They don't have, that brand risk. Let's just say like a Maple Leafs food does if something goes wrong. They operate very discreetly under, maybe 60 different banners, but they're everywhere. You just don't realize it.
Thank you so much, Rebecca. As a sandwich connoisseur, I could talk about this all day. Rebecca Telcher of New Haven Asset Management. Coming up, Rivian, the automatic or self-driving electric truck company, has unveiled its own AI chip designed to replace NVIDIA technology. We'll be right back. Rivian, the electric vehicle maker, is making a high-stakes bet that its own AI chip and a new LiDAR system will power its path to driverless autonomy. Bloomberg TV's Ed Ludlow reports.
Rivian's developed its own artificial intelligence chip for its future cars. That gamble might pave the way to fully autonomous driving. A lot of the tech world imagines a future where we don't own cars at all. We're talking about fleets of robo-taxis that are summoned through an app, maybe no steering wheel or driver controls at all. But Rivian's in the camp that does see people owning their own cars in the future and being willing to pay top dollar for a software platform that allows the car to drive itself. If this idea seems familiar, Tesla has been selling a version of it for years. Full self-driving supervised is not technically full autonomy if you read the fine print, but it can get you from point A to point B without needing to put your hands on the steering wheel. Rivian's path to autonomy is rooted in two big bets. The first, a custom AI chip developed in-house, which marks a big break from NVIDIA.
This is a RAP1 chip. It's a multi-chip module. In the middle is a Rivian-designed custom silicon surrounded by memory on two sides. The decision to build it in-house was based on a very rigorous analysis of the benefits we could come, and those benefits are velocity, or ability to get to market very quickly with it, performance, and cost.
The second, a major change in how Rivian vehicles see the world. The next generation Rivian R2 will have indented LiDAR sensors in it.
It's not just about the compute, it's also about the sensors, and it's about how they all come together.
This is Rivian Mark 1. What the Gen 3 architecture does with compute levels that are dramatically expanded. So just to put some numbers to this, at the platform level, 1,600 sparse tops. We can process 5 billion pixels per second, beautifully integrated LiDAR. That raises the ceiling to allow us to take your eyes off the road.
This will cause some debate. Tesla vehicles only use cameras as sensors for their systems, and what Elon Musk's company has always argued is that other sensors like LiDAR or radar are too expensive to scale. Until now, Rivian didn't really have an autonomous system. It had advanced driver assistance tools powered by cameras and radar. And Rivian used NVIDIA chips as the brain in the vehicle to interpret the world around it. Rivian says its new AI model will keep improving those older cars too, eventually adding capabilities like hands-off point-to-point driving. Rivian doing its own chip and ditching NVIDIA is a surprise.
On the Rivian processor side, this represents a significant cost savings to us. There is a lot of margin, of course, in the semiconductor space, and working directly with TSMC, we have a great relationship with them.
The new hardware is the unlock. It should allow Rivian to go from that driver assistance software in its existing lineup to true autonomy in the next Gen R2.
And the next big step is personal level 4. And what I mean is the vehicle can operate empty. It can operate without anyone in the driver's seat. It can pick your kids up from school. It can drop you at the airport. It's a complete shift in how we think about the vehicle experience.
Looking back, this was the company that pulled off the 6th largest IPO in US history, and it was first to market with full-size battery electric pickups and SUVs, beating out Tesla, Ford, and General Motors. But today, Rivian's struggling with the basics. Production of its EVs hasn't really scaled. Rivian's sole plant in Illinois is capable of building 250,000 units a year, but in 2025, it probably won't hit 50,000. The truest representation of that struggle, the stock is at a fraction of its peak. Right now in the world of tech, you have to have something to say about AI, and Rivian is diving deep into autonomy to appease its investors. an AI chip, LiDAR, and a large driving model. Right now, it's a promise from Rivian that their next generation vehicles will have genuine autonomous capabilities.
Ed Ludlow of Bloomberg TV. Coming up, there is a push on to buy Canadian, but a new Nanos poll indicates that the cost is holding some Canadians back. Most of us are trying to buy Canadian, but a new Nanos poll indicates that the expense is holding some Canadians back. We're joined by CTV's Camille Karamali. Camille, what do the numbers tell us about where Canadians are choosing to buy this holiday season?
Yeah. I mean, we've heard this nonstop throughout the trade war and since the tariffs kicked in that Canadians are choosing to buy Canadian, even if it means paying a little bit more. Well, that appears to be becoming much harder during the holidays, with many Canadians that were polled saying that cost is the biggest barrier in keeping that promise to themselves that they would buy Canadian. So you can see on your screen here, Nanos polling surveyed more than 1,000 people between the time frame of November 29th to December 2nd, and found 45% of respondents said that cost was the biggest barrier in buying Canadian goods for the holiday season, for holiday gifts. With availability coming in second, about 1/3 of those polled said they weren't able to find the gift that they wanted for their loved ones that was made in Canada. So that is a big deterrent there for many people. And then transparency about production. We've seen many of those products that we want to buy for loved ones saying made in Canada, but some of them don't clarify exactly where they were made. Especially if you go to big box stores like Walmart, it's tough to find sometimes under or around the product exactly where it was produced. Much of it produced overseas or made overseas in factories. So that is some of the hurdles that many Canadians are facing in trying to keep buying Canadian through the holiday season for loved ones, Andrew. And one thing that really stuck out from this polling is that most of those people who said cost was the biggest deterrent in buying Canadian for the holiday season were under the age of 35. So those in the demographic of between the ages of 18 to 34 said that about 60% of them said that they weren't able to buy Canadian goods for their loved ones as gifts because cost was the biggest deterrent. So a much larger chunk within that demographic saying cost is a big barrier right now.
That's interesting, yeah. And of course, we keep hearing that unemployment among that group is very high and they can't afford houses and entry-level jobs are scarce. So they're not, a lot of them not doing that well economically, apparently.
Yeah, that's the same trend we've been hearing all year. I mean, we did many stories on summer jobs and how youth were having trouble finding summer jobs because a lot of corporations and companies are a little scared about how unsettled things are and volatile things are with the tariffs and the trade war, not knowing what's going to happen next. So they're holding off on entry-level positions or opening up more entry-level positions, and that means youth are having a tougher time entering the workforce, and we're seeing it front and center now during the holiday season, Andrew.
Thanks so much, Camille.
Anytime.
Camille Karamali, our colleague at CTV News. There's new Canada Mortgage and Housing Corporation data out on the rental market, and it indicates higher vacancies and more units coming, but not much relief on rent.
It's a month-to-month.
Ali Jaffrey's rent is due next week, and right now he's not sure if he will have enough money to pay it.
The 15th of the month is just a few days away, and I'm in a difficult spot right now.
Jaffrey has a job, a child, and a tight-knit community in downtown Toronto, but he says the cost of living is squeezing him.
We want to make a life here, but we're doing all the right things, but we're still falling behind, and it's not a sustainable situation.
Today, the Canada Mortgage and Housing Corporation released its annual rental market report, which shows that despite an increase in purpose-built rentals and an increase in the vacancy rate, there has not been a corresponding drop in the average price of rent. The average rent for a two-bedroom purpose-built rental unit was $1,550 a month, an increase of 5.1%, while the average rent for a two-bedroom condo was $2,300.
The affordability challenges are still very present. That has not gone away.
But the CMHC says there are early signs things are improving. Many landlords are now offering incentives like a month of free rent or free internet to entice renters. And government policies from all three levels of government appear to be working, though experts caution it's early.
We're seeing a lot of programs that have been put in place, different products to help developers, push those projects out the door.
But to get back to pre-pandemic rent prices, the CMHC says housing starts need to double. They were down 17% in October compared to the month before.
The CMHC says there are currently 190,000 rental units under construction across the country, slated to be completed in the next year or so. They say that will keep the vacancy rate high and likely help with the cost of rent. Heather Wright, CTV News, Toronto.
Coming up, from Labubus to Shein, Temu and Luckin, Chinese brands have become global consumer favorites. We'll look into this growing popularity of these Chinese names. That's all ahead. Sales by Canadian wholesalers, excluding petroleum and petroleum products, rose 0.1% to $86 billion in October. And sales were up in 4 of 7 subsectors, representing about half of total sales. Increases were led by motor vehicles and motor vehicle parts and accessories and farm products. Another look at the surge in cannabis stocks after a report in the Washington Post that U.S. President Donald Trump is leaning towards drastically loosening federal restrictions on cannabis. Apparently, Trump plans to direct agencies to reclassify the drug as Schedule 3, reducing it to the same level as some common prescription painkillers. And Ford has stepped up the technology in its F-150 pickup to combat car thieves. The automaker has added a start inhibit feature that allows owners to disable an F-150's engine from a smartphone, making it impossible, apparently, for thieves to start the pickup. The National Highway Traffic Safety Administration says more than 800,000 vehicles were stolen in the U.S. last year, pegging losses at $8 billion U.S. And Ford's F-150, which of course is the most popular light auto in the United States, was in the top 10 of most stolen models. And there's a look at North American markets. The TSX hit a record earlier, slipping now, and U.S. tech stocks weighing down the broad market right now. From Shein and Temu to Luckin, Chinese brands have become global consumer favorites. And of course, they are seen as cultural ambassadors for the country. Much of the credit has gone to TikTok. Shoppers are hungry for more. Bloomberg's weekly doc explores this growing power.
Shoes, phones, windows to alternate realities. Many of our favorite products are made in China, but designed elsewhere. Well, that narrative's beginning to change a bit.
PopMart shares rise to a record as the CEO announces a new mini Labubu.
And the Game Award goes to Black Myth Wukong.
What we're seeing now is an emergence of Chinese soft power into the rest of the world.
In the past, China was creating all these low-value products, and it's very hard to gain soft power from that. But as you move up the value chain, the natural byproduct is that your soft power also increases.
We will continue to actually see more of them penetrating into various overseas markets.
As the power of China in the global economy has increased, it's an opportunity for them to go and invest in these other markets, similar to the way that American companies probably did in post-war America.
Although no one's saying that's going to be smooth sailing.
A lot of the challenges for Chinese brands, especially in the US, depends a lot on the political uncertainties that have been unfolding under Donald Trump.
Some are locked out of whole markets, while others have invited a certain kind of rhetoric.
The Chinese government has that data.
So, with Chinese brands seeming to win over global consumers, could they also help with something much less tangible? Soft power doesn't get much softer than these furry little enigmas. All right, calm down. These things, they're changing perceptions, one screaming child at a time.
You've got people across the world, across the US, on TikTok, unboxing their Labubus, showing off their hauls, from everyday buyer to a major celebrity like Lisa.
Riding that wave of hype has paid off for the brand behind the world's favourite new furry merchandise.
PopMart had one store when it opened in Beijing about a decade ago. It's now been able to open across the US, not just on the coast, but in areas of the US heartland like Ohio, and that shows just how far its reach has gone.
Since 2024, PopMart's annual revenue has more than tripled.
The overall sales grew as much as 250%.
Addressed the thank you card to TikTok, one of China's other major cultural exports.
TikTok is a really popular app in the US, and it now ranks among the top 5 social media apps, alongside the likes of YouTube, Instagram, Facebook.
The app has over 1 billion users worldwide, including over 170 million per month in the US alone.
And it really brought in a whole generation of young Americans and introduced them to a Chinese brand probably for the first time.
This is a crowd that loves to exclusively browse and buy online, a habit that's already second nature to most Chinese consumers. This chart shows the percentage of people who use apps to shop online and make in-store payments. Compared to the US, for instance, where about 40% of all retail payments are made using phones, Chinese consumers are far ahead.
There has been a generation of Chinese companies that came of age during this mobile-first e-commerce era.
Chinese companies have really had this advantage at home of being able to hone those strategies on these consumers.
And now Chinese companies are bringing that to your morning caffeine.
Luckin became China's biggest coffee brand in 2023, surpassing Starbucks for the first time.
That's in terms of sales revenue, and since then, its lead has only grown. But it's also true in terms of store numbers. As of October 2024, Luckin had 3 times as many stores in China as Starbucks.
In China, it offers drinks for as little as $1, and it's really forced Starbucks to rethink its playbook in the country.
For instance, Luckin customers can only order through a mobile app. That keeps staff and costs down.
And now Luckin's really bringing that fight to the US. It's opened a number of locations in New York, and it's introduced a few items for its fall menu that have pumpkin spice in them. Luckin Coffee is a great example of Chinese companies not only bringing their playbooks to the US, but now starting to adjust what they're doing to accommodate US tastes.
Another place ripe for expansion is here.
Brazil is very similar to China in the sense that you are seeing growing urban centers.
They also had a shift in their demographic to more middle class, so higher ability to spend.
And more importantly, a good part of that population are a lot younger and more willing to actually embrace some of these digital tools into their daily lives.
The retail apps are some of the largest and most popular now in Brazil, specifically Temu and Shein.
And more are looking to join the party.
Meituan, the food delivery business, planning to spend $1 billion over the next 5 years to launch Meituan in Brazil.
This came just as President Lula was visiting Beijing and signed a deal to allow more Chinese investment in mining, transport, and ports. You'll find this mix of government backing and business expansion in other places too.
There is a government push. They have the backing of Beijing to actually go overseas because China would also like to build its global footprint through its companies.
In part, that's because of pressure at home.
China has been going through factory deflation. These companies are facing downward pressure on prices because of intense competition. In order to survive in China, they have to go overseas because that's where they can charge higher prices, get higher profit margins. One of the biggest challenges that Chinese brands are facing now is, of course, the geopolitical uncertainties. We're talking about tariffs, investigations going on into certain sectors.
There is increased scrutiny on data privacy.
Take Huawei, for example. It was blocked from the US over national security concerns. TikTok's faced similar scrutiny, although there has been some softening there.
I like TikTok. That's why they're saying, are you saving? And we probably will save TikTok.
Keep TikTok!
Efforts to save TikTok is evidence of just how entrenched Chinese brands have become, and this familiarity could be shaping people's views. TikTok is popular in youth culture, and a Pew Research Center survey found that people aged 18 to 34 tend to view China more favorably than 35 to 49-year-olds, or the 50-plus crowd.
For an average user, I don't think they see it as a Chinese app or a Chinese retailer. They just think of it as an app.
And that's arguably what soft power is all about. It's meant to be nebulous and unidentifiable. But even if it is working, it's a long road. That same Pew Research data shows most of the countries surveyed still have broadly negative perceptions of China. So the longevity of Chinese brands may depend more on good business strategy than politics.
There are also a lot of questions about sustainability and whether a company like PopMart that's been able to grow this rapidly is going to be able to carry that forward, or whether it's something that's going to see a bubble that will burst.
Retention has become a big issue for GN and Temu. Amazon has 93% retained user rate in the US. Temu is like in the 60% range. So people are pivoting on and off their app.
Despite challenges, Chinese brands are probably here to stay, and this adds to the nation's growing global prominence.
We will continue to actually see a world that is incorporating more Chinese products as well as Chinese-backed services into their daily lives and into their work, with or without them knowing it.
It's a natural transition of the Chinese economy that eventually leads to the cultivation of the soft power as well.
Coming up, hot picks, we're going to check out 3 plays in energy. Gold trading near record highs again today. The price of spot gold is only about $40 down from the record we saw a few weeks ago. There is a look at the most traded gold futures. Spot gold got to a record high on October 20th of 4,356. And spot gold right now is above 4,300. Let's get more from Tom Windmill, portfolio manager at Midas Funds. Thanks very much indeed for joining us, Tom.
Hey, Andrew, it's a pleasure as always.
You think the biggest factor, or among the biggest factors pushing gold higher, is the grievous state of government balance sheets in many countries?
Oh, absolutely. You know, there's a lot of news about the geopolitical events, and yes, they do push the gold price around in the short term. But you know, that can reverse just as suddenly as it started, and then the normal offtake from jewelry manufacturers, you know, they don't come in the market when they see prices rise. They like to see things stable, and then they'll come in and buy. So the big factor we think at Midas is the central bank buying from creditor nations, and I think that's going to start picking up here now that we've had a rate cut in the United States, which usually results in the dollar drifting downwards as it results in interest rates and yields on financial instruments not being as attractive anymore. So they'll probably start picking up the pace of gold buying, and I think that's what we're seeing now.
And you're in the camp that thinks that governments with big debt loads, and I assume you would include the US there, they actually need inflation to try to keep the burden down.
Oh, right. I mean, what they want to do is pay these enormous debts, over $35 trillion in public debt, down in cheaper dollars. And the way to do that is just to keep making more. You know, the amount of dollars in circulation is up almost a third since the depths of the COVID crisis. There's just a huge amount of dollars sloshing around in the system, and we have that much, they just devalue. And now you're seeing these rate cuts, even though the inflation rate has not come down. It's a desperate move. We think at Midas to keep interest payments from becoming such a big part of the U.S. deficit spending. So when you have deficit spending, huge debts, the debtor countries in the world have to start inflating their dollars to make them cheaper. And the creditor countries in the world are saying, wait a second, let's reallocate more of our assets to gold and other precious metals to preserve the value of their foreign currency, their foreign reserves, as you will. So we think we'll see these debtor nations try to get out from under, and creditor nations moving away from those debt instruments into gold. And I think that's a long-term trend.
You don't think it's a great idea, though, buying gold bars as an investment? Costco, of course, has been doing that, as you know, over the past year and more, selling gold bars to the public. But you think that's a bit of an iffy idea?
Well, Costco is a very savvy retailer. So in that trade, I think you want to be a seller. And the reason for that, Andrew, is because spreads are not really understood that well when you're talking about gold. Some of these spreads in the retail world can be 10%. So you need almost a 11% gain just to get back to even. Much better we think, for retail investors, a regular investor, to own the stocks of really well-managed gold mining companies, because they have gold in the ground. They have gold in the process. They have gold everywhere, more than they can mine typically in a good gold mining company for 10 years. So buy the gold mining companies if you want to own gold, and then you get the upside of return on equity, because buying bullion is a negative return on equity, meaning there's an expense in just the insurance, shipping, costs, all that, even before you start talking about spreads.
So you guys have the Midas Discovery Fund, and I noticed Agnico Eagle is a big weighting as of October 31st. It was about 13%. That's a Canadian darling, of course.
It's a Canadian darling, and it's been that way for decades. They've been paying dividends for over 40 years. I think it's the best management team out there, and the current management is really a favorite of mine because they talk about per share returns. You're a shareholder. You want your shares to become more valuable. A lot of mining teams really are talking about making the whole company more valuable, and that's fine. But that often means the issuance of lots of more shares. So an individual shareholder gets diluted. Agnico is buying back shares. They pay a dividend. Top management team focused on per share returns. And even in the euphoric days that we're seeing now in the gold mining crisis, gold mining explosion upward, they are focused on cost control. They're a real terrific group.
I'm just looking at the top holdings as of October 31st. I'm interested to see neither Newmont or Barrick. And in fairness to you guys, I mean, you've got some lesser known names in there, DPM Metals, substantial company, but not among the giants, or New Gold. So you're not just buying the index, I notice. But Barrick or Barrick Mining or Newmont not making the cut in the top holdings anyway.
Well, of course, Barrick has very well publicized problems. After they merged way back with Randgold, they took on all those African assets. Now, to compare Barrick with its assets in foreign countries, we just talked about Agnico. Agnico focuses on politically safe jurisdictions. Why? I mean, Canada is probably the best place to mine in the world. It's got an established mining code. Agnico has excellent relations with the First Nations. Every community they go to, they benefit. But they talk about the fact that a gold mine takes 15 years to get your return on capital back. In many of these jurisdictions that Newmont is in and Barrick is in, just when they start to get the returns on capital, the local government takes over. And Barrick has had a horrible time in Mali and places like that. Let's stay away from far-flung companies with multiple time zones, lots of political risk, and let's stick with the really the blue ribbon, blue blood company like Agnico.
Tom, thank you very much. Tom Windmill, Portfolio Manager at Midas Funds. Coming
My
up,
pleasure.
Hot Picks. We are going to check out 3 plays in the energy sector. Hot picks, we're looking at energy, and we're in for a treat. We're joined by Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Jay, we always get fresh analysis from you. We usually talk about the broad market and the economics, government balance sheet, etc., and inflation. But we're zeroing in on some stocks here, and you want to start off with Cheniere Energy, the big player in LNG exports.
Absolutely. And we do have that's a big holding in AMZA, which is our pipeline ETF. And I actually founded an MLP, so we do know the sector quite well. So there's three stocks, but just one theme, which is natural gas. As we all know, since we're in North America, North America is the primary repository for all natural gas. We used to have an inland sea that split North America. Sea is what forms hydrocarbons. So we have a massive excess of hydrocarbons. And so one way to play it is through exports. So Cheniere is the leading exporter of natural gas out of the US. They were the pioneer. They have more trains coming on. So they're going to be growing earnings, and they're going to continue to benefit from the arbitrage between global natural gas prices and North American natural gas prices.
We're tight for time. I'm sorry. You're not concerned about the risk of a global LNG glut?
You know, it's actually almost better if there's a global LNG glut, because not so much LNG glut, but as long as the U.S. prices and North American prices stay contained, there's still going to be an arbitrage. And normally, LNG does trade pretty close to oil. So as long as oil doesn't crash, there still should be an arbitrage. There's also long-term contracts. But in the long run, natural gas is the critical transition fuel. So we think any temporary excesses will be absorbed because it's just a very both flexible and very environmental fuel.
We're Targa Resources, TRGP in New York. What kind of player are they in energy, and why do you like them?
So they're in the Permian Basin. They're actually gathering and processing, so it should be a little bit riskier business, but in the Permian, it's not. And they're benefiting from data centers being located in the Permian because basically gas is free there because the takeaway capacity is limited. So when those data centers get built, there'll be generation and they'll get better offtake prices for the gas they process. So great growth play in the best basin in North America, which is the Permian Basin in West Texas.
And then finally, Kinder Morgan, huge player in pipelines and energy infrastructure, kind of a supplier of Levi's jeans and picks and shovels.
Absolutely. So they're about 65% natural gas. So that finishes out the natural gas. So instead of processing it like TRGP, they just move it from places like the Permian down to companies like Cheniere for export, or to big natural gas plants that are powering the grid, particularly on the incremental side, data centers. So we think that that's the way to play energy. We're not super bullish about oil. We think they'll bounce off these lows. So low prices for oil and natural gas is actually good for North American exports. So throughput benefits from lower prices. So we don't want to gamble on the drillers or companies that have direct commodity exposure.
Jay, always great to talk to you. And thank you very much. Have a great weekend.
You too, Andrew. Thank you. Bye-bye.
Jay Hatfield of Infrastructure Capital Advisors. We are out of time on this edition of The Open. Maybe we could just pop up the gold price again, because gold closing in on record highs once again. The spot price of gold once again for north of 4,300, only about $20 away from its record high at the end of October. Thank you very much for watching our show. Have a wonderful weekend.